All right. Good evening, everyone. Welcome to this week's Sunday Macro Wrap Up for Sunday, November 17th. We're heading into the final couple weeks here of November. Can't believe that already. I mean, it's like, sheesh, this year's just flown by. But pretty exciting week. I mean, the last couple weeks were very eventful, obviously, with the election, with the FOMC press conference, as well as we had inflation last week. So this week isn't too eventful in terms of all the data that's coming out. There's still some good data that's coming, but we're just going to take a look at some of the data that came out last week, as well as go over some actionable ideas for those who are joining from our school community. We are, as always, we're live streaming the first part of this on YouTube, and then we're going to cut off the stream to go over actionable ideas as well as answer any one of your questions there. So I'll go ahead and start sharing my screen, and we'll get this thing kicked off here. Put a one in the chat there if you guys can see my screen. All right. So taking a look at the things that we track on a weekly basis. The main indices, namely the S&P 500 Qs, Russell, as well as these others. Really, the only thing that we're looking at changing is how precious metals, namely silver, copper, and gold, are losing trend strength with a strong dollar. And then also too, I mean, there's a lot of just decent sell-off last week, as we see in the S&P 500 and Qs. I'm paying attention to the setup. We still haven't seen a large increase in volatility, but we'll take a look at some of the charts too after I go over some of the macro data from last week here. So there wasn't too much on Monday. On Tuesday, uh, it was namely seeing an increase in both growth as well as inflation data at the same time, right? Which is pretty positive. Now, on Tuesday of last week, we received a large acceleration in small business optimism, right? And again, some have said this is namely because of the Trump presidency. And, a lot of smaller businesses are looking forward to potential tax cuts and those implications. We'll see if that, comes through. But we saw a large increase in small business optimism. Going on Wednesday here, what we saw was inflation, and this is something that we've been talking about for a while now. Inflation reaccelerating, right? So it came from a lower point of around 2.3%, and it rose to 2.6%. This was headline inflation, right, or 2.4%. What was also interesting is that core inflation, which removes a lot of the more volatile aspects of the CPI index, or of the CPI components rather, food and energy, that remained unchanged, right? And this is well above the 2% average that the Fed is trying to go for, right? But if we take a look at things that, already most of Americans already pay for, and they account for over 70% of people's expenditures, namely services, which is near 5% year over year, right? Which is way above the pre-pandemic average of 2.3%, right? So, services, out of all the things that Americans pay for, approximately 70% of our budgets go towards services, right? Whether that's, paying rent or paying for ride sharing or whatever, right? It's not necessarily goods. About 30% of all of our money on average, right? It's obviously different for everybody, but 30% goes towards goods, right? And so when we take a look at services inflation, it's way above that 2% goal of the Feds, right? Then when we take a look at shelter inflation, so this is namely rent, this is at almost at 5% as well. Again, way above the pre-pandemic average of around 2.7%. Housing inflation, 4.2%, way above 2.8%, which was the pre-pandemic average. So why is the Fed cutting interest rates when all these things, all these other components, which again are, hitting us the most in terms of our wallets, why is the Fed stimulating here? Do they see something that most people don't, or are they making it the same policy mistake as 2021, right? One other metric that we like to look at is the World Container Index, right? Because this is, a lot of the supply shock that we felt after the pandemic was in, the supply side of the equation with inflation, right? So if you look at and pay attention to shipping containers and the cost of shipping, you can get an early indication of where inflation is going next, right? So as you can see here, the peak in the World Container Index happened in September of 2021, approximately 6 months before the peak in inflation, which was June of the following year in 2022. And so right now, early in January of 2024, we saw this start to spike again and even get to a pretty higher level, not as high as it did back in September of 2021, but with keeping into consideration that lag of 6 to 9 months, it makes sense why look at this chart here and then look at headline inflation, right? Oops, let me get to it. So it's almost like, we're just starting now, picking up from these lower levels where shipping containers have that 6 to 9 month lag. So this is some upward pressure, as well as we talked about how comparisons from last year for inflation, right? Because again, the rate of inflation is measured with year over year, rate of change, right? And so as we see last fall, how it was declining, these comparisons are easier. So there's a higher likelihood that it rises anyway. But the Fed is cutting into this. So it's like a double whammy. On Thursday, we saw, scroll down here. On Thursday, we saw producer prices. So this is inflation that producers pay. That also accelerated, right? And then we're not just seeing the United States inflation start to reaccelerate as well. This is happening across different parts of the world too, right? You see Spain's inflation go up. There was some other countries too. I think it was on Friday here. Let's see. Let's see. UK GDP was accelerating. Yeah, here we go. So it's marginal, but France's annual inflation is increasing. Italian inflation is increasing. So it's not just the United States, right? Um, Now, on Friday, the retail sales number came in, and it reaccelerated. Not to huge levels, but still back to the higher levels of the year. And then the big number was, and I made a video on this, but the New York Manufacturing Index, which is one of the most important leading economic indicators for the United States. This had its largest 1 month acceleration to its largest level since December of 2021. Right now, again, we'll see if this sustains. This could be excitement from the Trump election, but we will pay attention to that. But this is also suggesting that growth is also accelerating, right? So if growth is also accelerating with inflation, that is a very big problem, for the Fed. That means they're making the same mistake as 2021, and they might not even be able to, keep cutting rates at this point, right? Because if you take a look at the Fed target rate probabilities for the last FOMC press conference in December, you can see that there's a 62% chance that they cut by 25 points or a 38% chance that they pause. Now you're thinking, okay, well, it looks like most likely that they'll cut. But what you have to see is that the progression of the probabilities is reversing on them, right? So as we get these hotter prints, look what the percentage was a month ago. There was a 72% chance that they're, cutting by another 25 basis points, right? So the probabilities of a cut are going down and the probabilities of a pause are going up. See how it was 26% a month ago and now it's, 38%, right? So that's the fear here because if they get this thing wrong and they have to start raising rates or continue raising rates, that means that we could enter a similar situation as 2022, right? Not to say that will have like the same type of drawdown as 2022, but they're making the same policy mistake. Taking a look at the calendar for next week using forexfactory.com, it's not as eventful as the previous two macro data dump weeks. The main thing that I'm looking at here is the flash manufacturing and services PMI data on Friday, as well as we get some really decent housing data, right? Now, housing typically is very interest rate sensitive, right? And so as we see that, even though the Fed is cutting interest rates, we're seeing the 10-year bond yield go up. We're going to start to see even more downward pressure on the housing market too. So a lot of the optimism from the anticipation of Fed rate cuts from a couple months ago, that has faded. So I'll be really interested in seeing that. So as of the election, right? If you take a look at the best performing asset class since the Trump election was Bitcoin and small caps, right? And these are some of the things that we've been long, right? That's why we were getting into things like Solana and SUI before, a lot of this when people were very bearish heading into the election, we were one of the few groups that were noticing that setup. So can this continue? Who knows? We are being strategic on how we're risk managing this, but that's what the facts are. Now, going into next week's earnings, we have NVIDIA earnings on Wednesday, right? That's the big one. Market cap $3.5 trillion. Can you guys believe that? That is insane. But that'll be on Wednesday night. And what was interesting from the previous NVIDIA earnings, if you guys remember the setup there was a lot of optimism and then it ended up in a sell-off. And when it comes to NVIDIA earnings, one of the metrics that I like to look at is the second derivative when taking a look at the rate of change of all the metrics that we look at, right? So we have revenue, gross margin, expenses, net income, and earnings per share. And what this takes a look at is the year-over-year rate of change from this year compared to last year. And it's the spread between those two, right? So like, for example, let's say that revenue grew by 18%, right? Let's say that revenue grew by 18%, but then last year, the year-over-year rate of change for growth was 20%. Well, the 2-year stacked growth between last quarter and this quarter on a year-over-year change is actually a -2, right? So it gives you a little bit more of the trajectory of where these things are going, right? And so last time we saw this, when we take a look at things like gross margin, you're seeing we had a big negative number. And then when it comes to net income and earnings per share, this has been decelerating, right? And so, if this continues to get worse, then, that's obviously going to put some downward pressure. I would want to see this be a little bit more positive on a 2-year stacked growth. But I mean, it's hard because in 2023, if you guys remember, the growth in NVIDIA was just absolutely insane. And so it's almost like a game of diminishing returns at this point. So Not to say that like we're going to hit a top and it's going to sell off at all, but that's the metric that I'm looking at, as well as what everyone else is, because I don't really hear too many people talking about the 2 year stacked growth, but it does provide some pretty good insights of of directionality of the trends, right? Um, Shifting on over, I wanted to point this out. So if you guys remember the chart that we talked about in one of my videos this week with fiscal dominance, right? So we showed a chart of, um, actually, I had enough people ask me this question, so I'm just going to show you guys how to pull this up on your trading view yourself, okay? So if we take a look at the S&P 500 here, one of the things that I like to look at is central bank liquidity, right? So this is a metric that I created that if you guys want to save this to your TradingView indicators, you can just find me on TradingView and just save it. Let me see, how do I? There we go. I still have it up a little bit here. So, so we have central bank liquidity here, right? And obviously, since the pandemic, central bank liquidity, they printed a bunch of money, and risk assets really were following along here, right? But what happened? 2022, they had to hike rates and liquidity started to get more constrictive. Well, this was going on a path that wasn't looking too good for the for the stock market, right? So, what did the government do in response to this? Well, they printed a bunch of money by issuing short duration treasuries by record pace, right? So issuing like treasury bills, and that was a form of them, spending money, right? Basically going further into debt and then spending that money. So let me go to this ticker here, USGSP. We'll just do new price scale. Then we'll change the color. Yeah, so as you can clearly see here, government spending took over, and that's what really has been propelling, you know, this. Not saying that this is the only reason why the stock market is going up, but when you take a look at just liquidity flows, you see that government spending and the stock market are clearly is what took this off of the positive correlation that the S&P 500 had with central bank liquidity, right? And so that's how you guys can bring this up and chart it. Central bank liquidity updates every single week, whereas government spending, we only get this information once a quarter, right? Jimmy asked, could they pause for the next meeting? Yeah, so we talked about that a little bit earlier, Jimmy. But to answer your question shortly, yes, there is a 61, or I'm sorry, a 31% chance that they cut. Looking all the way back to right here, or a 38% chance that they pause, 61 that they cut. So seeing how government spending and the issuance of treasury bills, this continues to go up. Now, with this new administration, the concerns that I expressed in one of my earlier videos this week was, if they have to slow this down at all, what's going to happen at that point, right? Is central bank liquidity going to have to take over? Well, that'll be hard because, if inflation gets out of control, then the central banks aren't going to be able to, stimulate as fast. So, to me, this is reaching an apex point. Obviously, this is going to take a while. This isn't going to happen overnight. But that's like the slow turning, like Titanic boat in the background that I'm looking at. And and a lot of the times during the Fed meetings when Jerome Powell talks, he always says, "Yeah, we feel that liquidity, as well as our monetary policy stance, is restrictive enough." But when you take a look at the Federal Reserve Banks of Chicago's National Financial Conditions Index, the NFCI, I mean, they're saying that, financial conditions keep on getting loose. And when you see this chart here, the way that you can read this is that the deeper this goes, the more loose financial conditions are, right? And so as you can see in 2022 here, this was the top of the market. See how it constricted back to zero? That this was a tightening of financial conditions, of it slimming down and getting more narrow. And then it widening is expressing that it's very loose, right? So, monetary policy is definitely not restrictive. It's very, very loose. While at the same time, one of the metrics that I like to track every single week is the Federal Reserve Bank of Atlanta's GDP Now, which is their measure of a real-time GDP estimate, right? Because the GDP number officially comes out every single quarter, but the Atlanta Fed does a pretty good job with tracking this every single week, and it does get updated, I believe, every Wednesday. And so they have the latest estimate for Q4 GDP at 2.5%. And this was an increase from the previous week because of all the improving data that we're getting. And so, if you're having growth accelerating while inflation accelerating, loose financial conditions, it still is like, why is the Fed cutting into this? It doesn't make any sense. Um, and again, it just the two questions is they're either making a mistake or they see something really bad coming that no one else is seeing. But given their track record, I think they're making another mistake. Um, Cleveland Fed. Notice how all these different websites I'm looking at are direct from the central banks, right? They have an inflation nowcast over at Cleveland Fed, and the year-over-year percent change, which is what we look at, right? So last week it came in at 2.6% for the October number. Well, the November projection is 2.7%. So you're going to get another hot reading, or maybe that's what the market is expecting. But again, it's another month of acceleration in inflation. Now, what does that mean in the intermediate or the immediate term, right? You have to still remember that we're in a period of seasonality. Typically, the months of November and December are, this is why they call it the Santa Claus rally, right? Because historically, looking over the past 20 years, you did have, an acceleration in the stock market. Um, and so you guys can access this by going to equityclock.com. And they have this chart as well for all 11 sectors of the S&P, as well as commodities, some other benchmarks too, and industries. So this is a really awesome chart. It's pretty interesting, right? Like May and June typically is like going sideways seasonality wise. So it's pretty interesting chart here. And again, this isn't every single year, right? You do have differences, but the way that the trend is going right now, I still think that we're going to continue accelerating into the end of the year, right? It could be one of the strongest Santa Claus rallies that we've seen post pandemic. Not declaring that a fact. I'm just saying it has a potential setup for that, right? While at the same time, one of the things that we talk about, and that's in the course, right, is implied volatility, and that is taking a look at the options market, right? So the options market, what is what is the options market expecting, right? With all the bets that they're taking on puts and calls. Well, when the implied volatility green line, this is for the SPY, when implied volatility is above historical volatility, that is implying a implied volatility premium, meaning that people are not protecting themselves to upside, right? Pretty much everyone's bearish, right? But then what we just saw recently was it flip again, and so now people are net bullish. So that's something to take note of, right? Bullish sentiment is starting to come back, whereas all along the month of October, which is where it had a huge rally, the options market was net bearish. So I am paying attention to implied volatility going into these next couple weeks here. This could widen a lot too, right? So this is just the beginning of the whole market becoming net bullish for once. Pretty much since September, right? And this website here is the optionseducation.org or just optionseducation.org. You can create a free account and then you just go to where I believe it says, if you go to the search and where it says historical and implied volatility, that's what you click right there. And it'll take you to this here. And you can look up any ticker that you want, which is great. So your favorite stock, let's say, let's go to NVIDIA. Okay, so NVIDIA, pretty interesting, right? We have implied volatility higher than historical volatility, right? Meaning that there is an implied volatility premium, meaning that a lot of people are bearish heading into the this next earnings report. So that's pretty interesting as well. All right, getting into some sector performance here. This is koifin.com. This is a website that's very, very useful. And so when looking at the 11 sectors of the S&P 500 on a 3-month basis, we have consumer discretionary at the highest performer, XLY at 20%. Next is financials at 16.2%. And then next is communications. So those are the sectors that are performing well. These are, pretty much turning around here because there was a decent sell-off last week. But those are the highest performing sectors. Um, I wanted to bring up this website because I'm sure you guys have, heard either on Twitter or, other types of sources where right now the Warren Buffett indicator is saying that this market is strongly overvalued, right? And if you were to just look at valuation, you would probably want to be all in cash, and then you would have missed out on all these great gains that have been going on recently, right? The way that we set this macro group up is that you never want to start with valuation because, people get this all wrong all the time because it's subjective, right? And you don't know how the market is changing. So never start with valuation. Even if yeah, maybe historically it is like overvalued and you should be cautious here, sure. But if you were to just go off of valuation, you would have you would have missed out on Nvidia. You would have missed out on all these other all these other stocks and cryptocurrencies that are playing towards the new like trends that are going on. So a lot of these models I think are broken post pandemic, right? And so I bring this up just to say like don't go off of just something that's valued. Um, One other interesting thing that I like to track is the ratio of insider selling and buying, right? So as it states up here, high peaks indicate a large proportion of selling versus buying, which is, negative. And then low troughs suggest a positive outlook, right? So as you can see here, you have the selling versus buying in black. Oops. And then you have in gray here the S&P 500. Now, there was net buying going on the way down, which is considered a bullish reversal signal. And then as this ratio rises, that is considered bearish according to this metric. Let me see if I can zoom in here for you guys. That might be a little bit better. Let me see. Yeah, so right here. So you can see that even though this accelerated a lot right before the S&P 500 had a little bit of a dip in August, that was a pretty interesting indicator. And we're starting to see this accelerate even more, not saying like, okay, if there's insider selling going on, we should all be selling and going to cash. No, that's not what I'm saying at all. It's just when you see this metric accelerate fast, it has historically preceded some type of sell off in the market. So it did start to accelerate. So I am paying attention to that as well. And then for this website, you can just go to fintel.io. And then this looks at the same chart, but just on a like a weekly time frame. So as we saw, we had a pretty large spike in net sales on, I think this was last week. We haven't seen that since March, right? The last time that we saw that. And then if you just look historically, when it's gotten to this, 400 level, this has only happened, let's see, one, two, three, four, only five other times since the pandemic. And it just happened for the fifth time recently on, yeah, last week. So seeing all this, again, it's not to say just sell everything and go into cash. These are all just metrics to pay attention to so that, we can risk manage appropriately, right? And then this one's openinsider.com. And so, yeah, last week when we take a look at all the sectors of the S&P 500, we did see net sell-offs mostly, and then we saw utilities actually have a green week, and this is a shift to defensive, right? Because utilities is normally a defensive play, and so last week, you know, this would have been a good time to buy some of the dips here, right, on things that we are bullish on. And then lastly, one other thing just to give us a little bit more confidence and something that I introduced on one of my videos a couple weeks ago is the World Diffusion Index for the CLI. Now, essentially, it takes over, I think it's 38 countries, and it takes a look at their macro indicators. And usually, when this metric on a month over month basis starts to decline, as well as the year over year basis starts to decline, it has historically preceded, large downswings in the market by about 6 to 9 months. And although, this started to accelerate, this troughed in July of 2022, and then it started to accelerate, right? And if you were just looking at this metric, you would have, bought the S&P 500 pretty cheap. Now we did start to see this accelerate, and we haven't seen it slow down yet, right? So that's good news. But we have seen it, stop going up, right? So this could be a trough. Who knows? This is also something I'm paying attention to, and it has historically gone higher in terms of the levels here, right? In terms of percentages. So, I am paying attention to this as well, and this metric comes out once a month too. And so we haven't seen both of these metrics start to decline yet. So that's one other thing to pay attention to, and also reinforcing why I'm still a little bit bullish here. Heading towards the remainder of the year, but still being cautious, right? So what I'll do now is I'll go towards the charts, and once you guys can see this here. So taking a look at the S&P 500, let me get rid of these drawings. This is on the daily time frame. Obviously, we had a decent sell-off. When we take a look and put on all the different indicators that we like to look at in terms of the math, right? Namely, the where is it here? Performance table, volume performance, net cumulative volume, as well as 30-day versus 90-day historical volatility. We can see that the S&P 500 is still in a clear bullish trend with its series of higher lows and higher highs. It's still on a performance basis, positive on a 3-month and 1-month basis. We are starting to see a little bit of an acceleration in volume on this up move, which is good. And then on this down move that we saw since last week, it was on lower volume. Let me just put on this volume metric here. Yeah, so when we see price declines on lower volume, that is a bullish divergence. Not to say that this is just going to reverse right now and go back up. You could still come down lower. Because as we're seeing right here with volatility, we are starting to see 30-day volatility start to become bullish on a 1 week and 1 month basis. right? It's still below 90-day, but what's interesting is that, as volatility rises, you could start to see crazier swings, right? And also, too, when we take a look at volatility itself, looking at the VIX here, as we were saying last week, when it was coming down to the lower end of its range, this was a great time to, take some profits, right? If you're being more short term, because now, if the volatility index of the S&P starts to move up, that's obviously bearish for the underlying asset. So that's what I'm taking a look at there. Let's just take a look at Qs real quick. Similar. I mean, we were being patient, went right up to the top end of its trading range, and then it came down, and now it's at the lower end. So, I did, purchase some at the end of last week there. So, we'll see what happens. That's what the process said to do, so that's why I did it. But again, you're still starting to see net cumulative volume start to become negative, so that's not a great sign. And then also too, you're starting to see volatility rise as well. So again, the trend is still holding. So that takes precedence over anything. And then you're still positive on a 3 month and 1 month basis. So really, what I'm looking for is, even though I bought here, if it closes on a trend break and you're starting to see sell volume accelerate. You're starting to see, maybe we see 30-day historical volatility cross 90-day. Then I'm just going to get rid of it, right? It didn't bounce the way that we want. Fine, whatever. There's other things to buy. Just get rid of it. Um, that's what's great about this process, is that it's pretty. You don't no emotion goes into it. You just execute, and then if things don't work out, it's okay. There's other things to buy that are doing better. So let's see here. I know we were taking a look at NVIDIA too. Yeah, so same thing with NVIDIA. It's holding its bullish trend. 3 month and 1 month are positive. You're seeing this sell off here on lower volume, so that's a bullish divergence. You're still seeing a huge, bearish on 30-day historical volatility, which is bullish for the underlying asset, right? So this is pretty strong here, right? Compared to Qs, how you already started to see historical volatility start to rise. Now it could rise from here. We'll see, but it's still clearly bearish there. Which again, bearish volatility is typically bullish for the underlying asset. And then lastly, before we turn it off of the YouTube streaming and go directly to the group for your questions, we'll just take a look at Bitcoin here, as it's the hot topic. Um, you know, let's start with volatility actually. So historical volatility is bullish, right? So that's something to be aware of. With a high beta asset like Bitcoin, when you have a very rapid rise in volatility, that's actually a good thing if price is going up, right? Now, if it does keep going up from here and we start seeing a decline, then that's not very good, right? So, as this goes up, you want to start taking incremental uh, profits, so that if it goes lower, you can just buy the dip. Um, so yeah, seeing that volume is declining here, we could start to see a bearish divergence, from volume, right? But again, with the macro setup being inflation and growth are reaccelerating, that is a um, that's an environment that Bitcoin really enjoys. So I wouldn't see, if this dips, I'm just going to buy it. Essentially, is what the answer is. All right. So with that, for people on YouTube, if you want to learn more about our macro optics community, you can use the link below and check it out there. For the people who are already in the community, I'm going to go ahead and end the stream here, and then we'll get into some actual ideas, as well as answering any one of your questions. So bye, YouTube. All righty. All right, everyone. How's it going?